All right. Hey, welcome back to the channel, everyone. It's been a while since we have been live. I think the last time I was live was the last FOMC meeting. So here we are again. Next FOMC meeting. We are expecting zero cuts today. Zero cuts. That's what the market is expecting. Lots of choppiness. Volatility is not high. According to the VIX, we're actually pretty low. I think the VIX was at 20 earlier today when I checked. But just a lot of choppiness yesterday, a lot of choppiness today. Tried to take a trade or two here and basically broke even for the day, as you can see here on screen. Locked myself out for the rest of the day because I don't want to get stuck in this choppiness and end up, blowing accounts or whatnot. I'm working on two more 50K accounts right now, and I'm halfway done with both of them. So, no sense in giving back anything that I shouldn't be giving back. So we have the Fed rate decision in less than 4 minutes here that we're going to wait and see. And then we'll hang out for a little while. We'll check in on some news, lots of stuff going on in the Middle East. We'll hop in and see what's happening there. I was just watching some live footage, and Iran had sent over another barrage of missiles just a little while ago. So we'll check in with some of that news and hang out. Maybe we'll talk about some of the trades that I took today. One trade that really I should have made um, or been successful with, but I wasn't because, well, we'll talk about it later. Anyway, welcome back. It's good to be back on live stream. Um, I kind of miss it, but also I'm glad that I'm taking a little bit of a break so that I can focus on my trading and, you know, get through it. That first 50K account that I passed, losing that kind of hit me hard. But we got back into the game. We passed the 150K account. We're now working on two more 50K accounts that we're halfway done with, that I started on Monday. And so we are starting to gain some momentum here. I am working on following my strategy very, very strictly and journaling all of that. And I can see how well it works if I stick to it and I am, you know, aggressive with it. A lot of my downfall is, I guess, trust in myself and my strategy. And so I miss a lot of trades because I hesitate. And you hesitate just for a few seconds, and that moment is gone. And then you're mad at yourself. So I'm working and struggling with that right now. But at the same time, I'm still making progress. So that's working out well. Let's see here. We have what, a minute left here. Again, we're not expecting any cuts. There's like a 98% chance of a no cut today. I don't think we're expecting a cut. I checked earlier today until September is the first time the markets are pricing in a 25 basis point cut. So the next couple of FOMC meetings shouldn't really change much. The data is still showing strong. Um, Jobs data came out today. The jobless claims that we normally get tomorrow, we got today, and everything is still coming in as expected. So there still is no reason for the Fed to cut, but Donald Trump is calling Mr. Powell out and looking for those cuts. So here we go, 10 seconds, and we're going to get our rate decision, and you guys can see how the market reacts. Here we go. Big jump to the upside, some volatility. I'm still waiting for the number to come through on my end. All right. Trying to push here right back up to previous highs, looks like. Looking for that number to come through. I would say just by the reaction, it's exactly what we are expecting is no cut. Come on. US rate, yep, no cut. So staying steady. The other thing that we're getting today is the summary of economic projections. So that's going to be big also. Um, we'll see if we can pull that up once it pops up here so we can just kind of go through and see what the FOMC is looking for in the future. Okay. And then obviously at 2:30 we have Mr. Powell comes out and speaks. Okay, so FOMC median forecast still shows 50 basis points of rate cuts in 2025. So they are still projecting two cuts or 1 to 2 cuts this year. Okay. Hello. Welcome, welcome. Uncertainty about outlook has diminished and still elevated. Yes, yes, yes. We're going to hear about uncertainty for forever. All right, so Fed medium rate forecast, the next 2 years, actual rate 3.375%. They actually raised that. The forecast was 3.125. So that's not good. That's probably why the market is coming down a little bit because the forecast for 2026 and 2027 is 3.6% and 3.4% respectively. So we're still, according to FOMC, not going to be down to 0% or even like 2%, right? I don't know that they'll ever go back down to 0%, but 2% or so. I mean, we're 2 years out now. We're looking, and we're still going to be up in the 3.5% area. I don't know. Fed sees 1.4% GDP growth in 2025. Inflation remains somewhat elevated. Yeah, like slightly. We're at like what, 3 point? No. Are we even in the 3%? No, we're not. We're at 2.4%. As of May of 2025, inflation is at 2.4%. This is ridiculous. The Fed's it's a little ridiculous. They should be coming down much quicker than they are, and they give a forecast to still be up at like 3.5%. 2 years from now is crazy, in my opinion. That's ridiculous. I'm not saying we need to go back to 0%. Clearly that didn't work, but Yeah, so we're looking at a 71% chance of a Fed cut in September now. That was just down at I think 40 or 50% a few hours ago when I checked it. So a big jump there just from the economic projections here. All right. I mean, it's not really a huge reaction here from the market. It really hasn't moved much from where we have been most of the day. We're starting to push down a little bit now. I wonder if we're going to continue down. It also obviously depends on how Daddy Powell comes out for his press conference. Yeah, it's true. I mean, so it is being careful. The only reason why I say it's ridiculous is because the Fed has never been right ever with timing on either adding uh interest rates for inflation and then therefore cutting afterwards. They've never been on time. And historically, they're usually always very late when it comes to that stuff, right? So the problem we're having here is if they wait too long, then they're going to create a recession that may not necessarily need to happen, right? The longer you push this out at these high interest rates, I'm not saying they have to cut down to zero, right? But I don't think there's any reason for us to be at 4.5% right now. I think that's a little crazy when the data has been really good for more than a year now. Everything has been going in the right direction. Yes, you have these little tick ups, just like the market, right? You always have a little pullback. So even with their data, you're going to have these little tick ups or whatever, but nothing has been sustained and everything has continued to fall. And like I said, below 3% inflation right now. I think that they could be a little bit lower, um, even if they were doing 25 basis point cut here and there. You know, just to give a little bit of enthusiasm to the people, honestly, right? Because they're the ones that are going to go out and spend money. And if they're spending money, then the economy will do better. Yeah. I don't disagree with this. Sometimes you need a recession, you need a good reset. Sometimes you need a good reset. Um, it's a very fine line to walk, right? Economics. Very fine line. And you're right. When Mr. Powell's term is up, I'm quite sure there will be somebody that gets put in place where cuts will get or rates will get cut um, pretty quickly. You're not wrong there. So we'll see what happens, right? We'll see. All right. Well, we have the conference coming up in about 20 minutes, and then we'll see how the market does with that. Yeah, traders still almost fully pricing in two Fed cuts this year. Yeah. Fed sees a 4.5% unemployment rate at the end of this year versus the 4.4. Um, October's rate cut odds is up at 85% now. So we're looking at a September cut and a October cut as of right now. It's very far away. Obviously, a lot of that can change. All right. We'll see you tomorrow. All right. So markets had a nice little push up earlier today. Um, Lots of consolidation, little drop right before a little drop and move back up here right before the decision here. Now we're right back where we started this morning. So a lot of sideways trading yesterday, a lot of sideways trading today. All right. let's see if we can find any news, unless you guys want to go over the trade that I messed up today. Let's see what Bloomberg is saying here.
Oops. Are we unanchored where there's a new monetary sphere out there of monetary policy people, I should say?
Tom, I don't think so. You know, there was a paper at the recent Fed conference about unanchored inflation expectations, so I know it's on some folks' mind. I don't think we are. In fact, I think Jay Powell's focus really right now for the remainder of his term is to be darn sure that when he leaves that we are anchored. And I think, you know, that's probably part of what's going on, and we'll hear about it today at the press conference.
Is there anything that gives you pause, Bob, about the idea that maybe we aren't really fully appreciating some of the inflationary risks at a time when, yes, the backward-looking data has been better than expected, but looking forward is pretty complicated right now?
You know, I was sitting here thinking, actually, the Fed did almost exactly what everyone expected. They didn't hike rates. When I go through their forecast on GDP, inflation and unemployment, directionally, they're where everyone was headed, so they kind of match that. And I think 3% inflation looks to us to be very aspirational. When I look at Mike Feroli's forecast, he has inflation peaking at 4.6% in the third quarter. And that's on a seasonally adjusted annualized rate, but that's a very high number. So I think, yeah, there is some risk that we may be underestimating what tariffs and higher oil prices could do to inflation, and whether the One Big Beautiful Bill Act has enough power into it that it helps to entrench higher prices.
And Diane Swank, with your charm of the Midwest, there's one big beautiful interstate system out of Chicago moving south, which is directly affected by goods, tariffs, and the rest of it. What do you observe in the Midwest? Are the tariffs clicking in now? Advise the chairman.
Well, they know what's going on. They're hearing it from everywhere. And what we're starting to see is not only are firms doing whatever they can to mitigate the costs of tariffs, they're also starting to see some disruptions due to supply chain problems that you can't undo overnight. And I think that's very important as well. That's only just beginning to seep into the data, but it's very reminiscent of the pandemic. And I think that's why the Fed is still on so much guard. And this is a purgatory for them, because they are very concerned that the unemployment rate will rise, or it may not be signaling, as Rich said, what it might have otherwise signaled, because we'll have pockets of tightness where immigrants used to be and they no longer are. We're already seeing that in the care economy, and we've been tracking it, and the slowdown in elder care in particular, where there's a disproportionate amount of foreign-born workers in that area. That employment has fallen basically to nothing. And in fact, that's where inflation is also moving up at several times overall inflation. So those are pockets that, you know, you get a little pocket of it. Is it enough for the overall economy? When you've got the aging demographics we do, that's something you want to worry about. Along with, we have childcare disruptions as well.
Diane Swank of KPMG, thank you so much for being with us. If you are just joining us, the rate decision was unanimous, and it was a decision to do nothing, at least when it comes to the actual rate, holding it in the benchmark rate zone of 4.25% to 4.5%. The one aspect, though, that caught everybody, or some people, off guard, Neil Dutto again would say, absolutely, this is not surprising, is that they are leaving their dot plot at 2 rate cuts for the remainder of this year. They did lower their GDP estimate it to 1.4% from 1.7% in the March summary of economic projections, and lifted inflation from 2.8 to 3%, but they still kept their rate cut expectations the same. Talked about uncertainty diminishing, but still elevated, Tom, at a time where we're all kind of in this policy purgatory that Diane was talking about.
I know you want to go to Matt Lazzetti here, but to me, the arch issue, I've said this, you've heard me, the Bramall Cam once got her, she was very upset at me, boring her with this. Can you aggregate America? If you're Richard Clarida at the Fed, or Matt Lazzetti at Deutsche Bank, or Bob Michael at JP Morgan, Greg Peters, any of them, can you aggregate American economic data, or is it a barbell economy of those healthcare workers Diane Swank just spoke about? They're desperate and unreplaceable, or fancy people you're living with every weekend north of New York City. I mean, which is it?
Well, you know what? This is a great time to bring in Matt Lazzetti of Deutsche Bank to answer all of those questions and address them. Matt, thank you so much for being with us. Let's start with your reaction. Do you view this as a dovish move by the Fed, as it seems to be treated in markets?
Look, I think it skews slightly dovish. We thought in a very close call that they would go to one rate cut this year rather than two rate cuts. But when you look at the overall change in their economic forecast, it's very much in line with what we anticipated. And you have a committee where 7 officials expected to not cut rates at all this year. That's up from 4 in the last SEP. They actually raised their dots in 2026 and 2027 because they think inflation is going to be a little bit more persistent. And so the way that I view this, the median for at least this year, it was kind of a managed kind of agreement that they would keep it at 2 cuts at this point in time. Don't want to rock the boat. There's still a lot of uncertainty.
All right, let's see if we can find something else here to watch. I don't think there's any reason why they couldn't be cutting rates at small amounts, you know, based on the data. They keep talking about how they're solely based on data, except what they're doing right now is not cutting because they don't know what's happening in the future. Well, none of us know what's going to happen in the future, but if you go solely off of what the data is telling you, they should be cutting. And like I said, you go small, 25 basis points here and there. Even if you took a month off or, a meeting off in between each one, at least you'd be working towards something. And if you get inflation that rears back up in a larger way, it's very easy to either stop where you are at that point or, increase interest rates if you have to. Well, I don't see why we're sitting on our hands and doing nothing. Trying to see if I can find any live news on what's going on in the Middle East right now. Because they were just talking about oil prices. Now, oil prices are not going up right now because of tariffs. Okay. Oil prices are going up right now because of what's happening in the Middle East. And yes, if oil prices continue to go up, it is going to make things more difficult um, here at home and for everywhere, right? For anybody who has to pay for gas or oil or anything like that, those prices are going to go up. And if those continue to go up, um, it is going to make it more difficult for people to live. Prior to all this happening, oil prices were coming down really nicely. That was helping. It's not out yet. Now we got about 10 minutes left here. Still getting some choppiness in the market here. Mm, mm. Everything is waiting on the FOMC right now. Well, here's some live footage. See if we can't see any. So they did just strike or sent some missiles from Iran over to Israel again earlier today, just before sunset for them. There's a live look. Nothing going on there. Seems pretty quiet. Seems like even the market doesn't really care about what's going on in the Middle East yet, anyway, until we get involved, right? Once we get involved, then I'm sure the market will care. Let's see if I can find something else here. We still got about 8 minutes or so until Daddy Powell comes out. Fox Business is just stuck on that. Associated Press, nothing. Yeah, nobody's talking about Iran and Israel right now. So, guess we'll hold off on that. Let's go over here. Just wait for Mr. Powell. All right. Yeah, he's coming out in 7 minutes. He's usually always on time. So we'll wait for him. Not much else going on. Yeah, I'm surprised that the market's not falling more than it is based on the outlook of inflation that the Fed just put out, which they've increased from the last one, it looks like. So, but we'll see. I mean, we could get a dump here once Mr. Powell comes out and speaks, depending on whether he's a little dovish or hawkish. You know, he's usually pretty good at being mostly middle ground. And he's very, very good at not answering questions that he shouldn't. So we'll see how that goes. And the press is very good at asking questions that they know he's not going to answer. All right. So All right. So yesterday I didn't take any trades yesterday just because yesterday was all choppiness. We just traded sideways within a range all day. No entries. Today, a little bit of the same thing. We actually did get a little bit of decent market structure here, some price action. This move here right at market open where we pushed down into liquidity down here, I actually called this out to my wife this morning. I said, once this candle closed here, I knew that we were reversing, and I told her that if the following candle does the same thing, which it did, I should get in, and I didn't. So I missed that trade here. Look at this beautiful move right up to key levels. But what I didn't miss was this trade here, where I waited for price to push back above my key level here. I waited for price to come back down to retests after breaking previous highs. Retested it perfectly, strong push off with a close. I tried to get in right on this close here, but with some slippage, I ended up just above the close of this candle. Still a beautiful entry here, and price rocked to the upside here, breaking additional previous highs. What I did here, huge mistake, which I do often, and I know what I do, I moved my stop loss to break even, and that candle wicked down, took me out at break even, and then you can see how the move continued on, up to my take profit and beyond. This would have been a beautiful trade. It was the trade of the day. Would have been all I needed, and I got taken out because I moved my stop loss much too soon, which I do a lot. Something I have to work on. If I left my stop loss where it was initially, it never came down that far, and I would have continued on with that trade right up to TP. But that was it for today. I knew that once we had this little structure here, that we were going to just get consolidation, which we did, but consolidation to the downside. But there's nothing here, as far as I'm concerned, with my strategy and whatnot, for entries, and I didn't want to get stuck in any of this chop here. As soon as I locked myself out for the day, this move was made. Right back into that liquidity zone down here with a nice push back out. Right. This candle here actually might have been a nice place to try for an entry here, but on a day like today with FOMC and whatnot, it's just not worth it. You don't know where price is going to go, and a lot of times your key levels and stuff don't have to hold like they normally would, with big news coming up like the rate decision. Not to mention we had things going on with Iran and Israel at the same time. I think this kind of happened right around the same time that Israel was under attack again. So, unfortunately, when things like this happen in the world, here we go. Daddy Powell. All right, guys, enjoy.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
But we're going to do nothing.
Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension, If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby
Here we
Smith
go.
with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East
we're at a pause
adversaries
for
with a
tariffs
possible
still.
U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's
There's always uncertainty.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates?
Why is he bouncing
going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing. And we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market. And that's the best thing we can do for the housing.
Which he has said, by the way, that the labor market has been strong for, months now, right? This is the problem that I have. And the economy isn't going to grow if we make it more difficult for businesses to hire people, to take loans out, to open off the they're holding back the economy, in my opinion, keeping interest rates as high as they are and doing nothing, even though, like he just said at the beginning of this conference, everything looks good, is killing the economy right now.
We'll be watching the data carefully.
Well, just quickly on, given that, there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence?
He just said uncertainty is lower than before.
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So
they're not going to show up in the summer either, because we haven't really had them. They've been on the pause for 90 days.
Meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
For now.
Nick Tamarosa of the Wall Street Journal.
Nick T.
Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
The simple answer to that is people are people and they have their own opinions.
And that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Very different from the very data-dependent Jerome Powell
Michael McKee from Bloomberg Radio and
a few months ago and even last
your
year,
friend
right?
down
That was
at
his, we're
1600
data
Pennsylvania
dependent,
Avenue
follow the
continues
data,
to lob
never
insults
forward-looking.
in your
This is
direction.
the first time I've heard him say that.
Given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy?
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in the short term?
With what picking up?
Workplace raids.
Oh, jeez. Here we
So you're
go.
asking immigration.
Yeah.
I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential
Where's he
changes
from?
to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this
Market's
meeting,
heading for
though,
lows.
is we sort of prepared the ground for that.
We go.
We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas.
Washington
People offered
Post.
a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have
new
very
lows
broad
on the day
support.
today.
And also, you want to be really careful because
Oh no,
I
not
think
yet.
our communications are pretty well received.
yet.
They're not broken. So
Heading for lows of the
more is
day.
not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting
From
then
CBS. Look at
when
that.
inflation was higher than where it is today? And you
What a
didn't
great
cut today?
question. What a great question.
The forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs
still
are
don't.
going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans.
That's what I was
When you
saying
look at
before.
the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions.
But
without
you
having
can
to
make
think
it a
about
little
inflation all the
easier
time.
on the way
So
there.
in the meantime, we have to keep rates high to get inflation all the way down. they're not very high. Let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably
7%
modestly
interest rate for a
and
mortgage
so what it will
is
take
very high,
is
man.
confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good
So why are
economy
we sitting
and
at
a solid economy with
4.5%?
decent growth?
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what
It
I can
is what
say
you're saying.
is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that.
So why couldn't we be reducing rates, okay, until you get the information that you want? Because we don't even know if there are going to be tariffs that will be, you know, higher than they were expecting is what his excuse is. And if they are, then maybe you pause and or raise rates if need be. I don't understand why we're sitting here doing nothing when you know that it is killing the little people like you and I with these interest
Consumer
rates.
buying it, and all through that chain, people will be trying not to be the ones who pick up the cost. But ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past.
The problem with what he's saying, though, is if people cannot spend more money, which is where we're getting to, okay, then the tariffs cannot be pushed onto the consumer because people won't pay for it and other companies will eat it. And there have been companies that have already said that they were going to eat the cost of tariffs instead of pushing it onto the consumer. So he doesn't know that for sure. That's the thing. You don't know that for sure.
I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If you know, at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you.
I'd be interested to know what businesses he's talking
in February,
to.
you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public. We're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're going to hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate. But it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, well, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
I bet you it has more to do with them not trusting the Fed and the government.
Hi, Victoria
and that's
Guido
why
with
they're not
Politico.
participating.
So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually
I'm not
be
thinking
durable?
about that right now.
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with it, with AI, will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change.
It's a good question.
From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. And it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. But you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Should ask ChatGPT.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence.
Cut rates.
So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
Okay, that was fun. Well, there you go. The Fed doesn't want to do anything, which has been their stance for quite some time now. And again, I don't understand why he can't be sitting at a comfortable place at 3.5% instead of 4.5%, and still be able to act quickly or react quickly to anything, tariffs and whatnot. I mean, we have no idea what's coming up with tariffs. We have no idea what's going to happen with the Middle East and whatnot. But if you're going to go off of just the data that we've been getting, we should be lower with interest rates, I believe. And again, not saying we need to be down at 2% or zero, but there's no reason why we can't be a little bit lower than where we are now, and we might be able to see some increase in GDP with that because maybe businesses will start taking out some more money. Maybe businesses will start to hire some more people. The economy is stagnant, is what it is. That's what he's saying there. Like, we're not laying off people, but people that don't have jobs can't get hired. Well, that's because it's too expensive. It's too expensive. These interest rates are too high. And nobody knows what's going to happen, but some companies, especially the small companies out there, uh, are less likely to do anything to make any changes with their businesses because it's just too expensive right now. It really is. So anyway, well, there you have it. No rate cut, and we're not expecting a rate cut until possibly September. Right now, market's pricing in September, October for 25 basis points each. The Fed is calling for possibly 2 rate cuts this year, and they increased their outlook on where inflation is going to be for the next 2 years. So, really not much movement in the market, honestly. We've stayed in today's range of price action. So, I mean, even the market's not doing much. So we'll see what happens. No trading tomorrow. Markets are closed for Juneteenth, and then we'll be back on Friday. So hope you guys all enjoy the holiday. Thank you guys for watching. Appreciate every single one of you. Don't forget to subscribe to the channel if you haven't already. Like, comment, share, turn on notifications for when I do post videos and come on live. And if you guys haven't already, also join the free Discord. The link will be in the description for this video down below. And yeah, thanks for watching, and we'll see you next time.